Omicron has picked up speed, spreading around the world. Inflation has also jumped up a little further and has been persistent. The Fed has started tapering bond purchases, and we have new capital market projections. All of that and more today as we go through quarterly context with you. We look forward to this discussion. This is Greg Patterson, I'm CEO of the Advisory Group, and welcome to our fourth quarter 2021 quarterly context webinar. For those of you not familiar with the Advisory Group, we are a wealth and life strategy firm focused on helping businesses and owners and leaders with their financial goals in their personal family realm, their fiduciary employee support efforts, and their communities through their foundations and endowments they support. To help that strategic goal work we do with clients, our quarterly context webinars are designed to make economic and other information approachable, high-level perspective regarding the economy, markets, and investor behavior patterns to help personal wealth and institutional clients all stay more relaxed by staying more informed and to make better decisions towards your goals. And the first section is relatively high level. Section 2 has some additional details and charts for those that want to stick around for that section. We'll try to keep the first section to about 15 or 20 minutes, and we'll also circulate a video link later should you like to view some part of it again, or to pass it on to someone who you think we can help like we've helped you. If you have any questions, please submit them to the question box, and we'll address those either as we go along or at the end of the presentation. So let's get started. As always, we like to remind people that the most important things to focus on are those things that fall in that space between the things that matter and the things that you can control. You can't control markets, you can't control inflation, you can control how you plan, you can control the choices you make in being a disciplined investor, saver, planner, and so forth. The headlines for the quarter, nothing too shocking, but as always, little bits and pieces push the market up and down, whether it has to do with stocks and oil or COVID and the Omicron variant and expectations about how that might affect the economy currently and moving forward, and how long that might last or not, inflation factors and so forth. We'll talk about some of those details. So the slow vaccine adoption has, according to scientific and medical community, essentially led to the new variant Omicron, and there apparently are some budding other new variants out there as well. And without more global adoption of vaccination, it's likely that we will maybe in this problem for quite some time, maybe having COVID versions of it be more like the flu and built into future flu vaccines. Not clear exactly how that's going to play out yet, of course. Fed rates are still near zero. The Fed did start tapering bonds to the tune of about $15 billion less per month. So that is a sign that the Fed is trying to reduce the overall stimulation without doing it too dramatically. And there has not been the same type of quote unquote taper tantrum like there was after the global financial crisis, or in the middle sort of the beginning of the end of the tapering away from stimulation after the global financial crisis, where the markets really got very wobbly for a little while as the Fed started to pull back. Unemployment has been improving a little bit, and wages are up a little bit. However, consumer confidence is falling in part as some of the stimulus savings that were accumulated have been spent down, and inflation concerns are up. Omicron, COVID concerns are up. That COVID element is also creating an expected drag on GDP, which is making markets a little wobblier. However, you wouldn't really notice that in the fourth quarter strong U.S. market numbers. We'll talk about that in a minute. China has been cooling. That's pulled down emerging markets closer to 0% after what some are saying is a unusually and maybe even suspiciously high consistent growth period over a number of recent years. There's some view that there is less transparency and more manufacturing of publicized numbers there. Inflation is up even further, up to about a 7% rate as of recently annualized. We'll talk more about that in a few slides. The Fed has pulled back from their comment that they believed it was going to be brief and transitory, which sends a signal that it may last a little longer than expected, but it's not expected to jump up to dramatic levels or be present for a truly extended period of time. A lot of that is due to supply chain problems and other factors. Again, we'll talk more about that a little bit later. In terms of market cycles, growth beat value, large beat small, US beat international, which really represents a return to the return patterns that we saw during the stay-at-home trend in the early COVID period. The types of stocks that benefit from that type of shift in spending and behavior tends to favor those types of stocks. Taking a look at the coronavirus numbers, it's pretty amazing to see how the current spike looks compared to what seemed like huge spikes with the initial COVID wave and then Delta and so forth. So cases are way up. Luckily, most cases seem to be relatively mild for people who've been vaccinated. The hospitals are filling up primarily with people that have compromised systems for those that have been unvaccinated. So that complicates a number of things. We are still smack dab in the middle of the flu season, and so that also has some effect on the numbers and the announcement that there was a sort of a flu-COVID combination effect in some cases as well. In terms of the broader economic indicators, unemployment, as you can see here in the upper left under number one, has ratcheted back down from the COVID peak to somewhat closer to more normal levels. So there's still a lot of people looking for work, or quote unquote looking for work, but still surprising how many people, organizations are trying to find people and struggling. So it's a little bit hard to reconcile that. There's some different theories about what's going on there. Wage growth, as you can see here, bounced around and has picked up a little bit. Inflation has ticked up, as you can see, or continues to tick up, as you see here at number two. Consumer sentiment is making one of the more noticeable changes in these sets of charts, cooling back down to levels we haven't seen until here at the bottom of COVID. So people are a little bit more worried now as this continues to extend out further in time, when people thought we would be long past COVID by now. A chart that doesn't seem to change a lot in the last number of years, but you can see the Fed funds rate remains this near zero level and ratcheted up as things seem to be improving post global financial crisis, and then COVID hit and pushed it back down to zero. So we've had an extended period of high stimulation of the economy through low rates, as well as the bond purchases mentioned, as well as other programs from the government during COVID, and that is part of what's been boosting stocks and the economy. And now the Fed is challenged a bit with needing and wanting to raise rates to have dry powder for the future, but not wanting to do that so soon that it cuts the legs out from still a slow recovering economy. Slow recovering economy despite surprisingly strong stock numbers, you can see here, with the U.S. up more than a full year's expected return for the quarter and almost 26% for the year. international at what looks like a relatively paltry 3.14%, but that annualizes out to 12 to 13% per year, which is considerably above the full year projection as well. International emerging stocks rather negative in great part due to China's weakening economy currently. Real estate particularly strong, and bonds relatively flat in an environment where rates are expected to start rising, at least in small incremental steps. Looking at the 4 bad bears chart, you can see what not too long ago it looked like we had some dips along the way, starting to fade into the overall pattern of the line with this continued rise. So just notice how unusual this is compared to other major markets. This top slide is after inflation, or adjusted for inflation, otherwise known as real returns, which are the returns you can actually eat, the returns you get to keep and spend versus what's eroded by inflation. So there is inflation, but stock returns are more than making up for that. Bond returns, of course, have been a lot cooler as you'd expect, and should be on average a lot cooler over the next number of years, given that we had a long-term yield compression which puts bond prices up, and now with low rates as bond rates rise, that puts downward pressure on bond prices for a while. However, bonds are of course very important and valuable for certain people and organizations if the rates stay, depending on strategy, as downside protection when stocks get wobbly. So they still have their place, even if they are expected to have weak returns over the next decade. Again, referring to bonds specifically, while we're looking at stocks here on this chart. Looking at a couple different periods of returns, here's an updated chart for the 10-year. Still amazing to see that the large cap stocks have been in the 13 to 20% range. The large cap growth stocks, which are dominated by a number of mega cap tech companies, the FANG stocks, Facebook, Amazon, Netflix, Microsoft, others, Google, it's known as Alphabet, so that is highly abnormal, highly fortunate, but very unusual, and don't expect that to remain that way forever, because the reversion to the mean effect does happen eventually. We did have some reversion to the mean where smaller cap stocks for a while were picking up speed after, and value stocks after 30 being out of favor, but as mentioned, the stay-at-home factor has pushed growth in large cap stocks up a little bit more. Looking since the market low, here's a great reminder of the reward of being disciplined. Right when it's scariest to stay in the market, at the very bottom, deepest, darkest point is the darkest before the dawn, and big returns since then, much more than making up for the pullback in returns for the initial Omicron pullback and scare. Bond yield curves, Treasury yield curves did shift upward here. You can see this gray line move up some sections in the early part of the curve here, and not dramatically different overall. Still a little bit lower in the longer periods, which is suggestive of a slight flattening of the curve, which implies a little bit a weaker growth outlook, in part probably due to the Omicron factor. As mentioned, we'll talk a little bit more inflation, since that's been a little more persistent than some originally expected, hovering around 7% annualized currently. What's interesting to note, however, is that I guess what we're surprised is that people are surprised about inflation. We've been talking for quite a while. If you go back a few years and listen to some of these quarterly contacts, we'll say, hey, well, inflation should be happening. Should be more inflation happening. Don't be surprised if inflation picks up, because when you have a massive monetary and fiscal stimulus, that sort of injection into the money supply historically tends to lead to higher inflation. And so that's had a big stimulus of that sort, combined with supply chain challenges related to COVID and employment and production and shipping and a whole bunch of factors. So those factors combined, it's not surprising that we would have at least a temporary shift. Especially with incomes having gone up a little bit, with wages going up a little bit, that gives people a little bit more purchasing power, while at the same time having pent up demand. And so, we're not particularly concerned, and most of our personal wealth clients aren't affected quite as much. Some 401k plan participants might be at the lower end of the wage spectrum, might be feeling it a little bit more in some areas. In some cases, a lot more, but yeah, we don't expect it to be a long-term problem. It's really, for example, unlikely that people's future buying patterns will continue to increase in a way that will push inflation up. Supply chain factors should resolve themselves, although that could take some time, but should normalize as some of the COVID elements stabilize over time. And some would say that some economists we talked to say that inflation might normalize and maybe even reverse in a year to a year and a half from now. And in some ways, you can think about it like how the home improvement projects led to a big spike in demand for lumber and other products, and then things cooled off and people had already done their projects. That kind of pricing wasn't sustainable, so there was actually a big reversal in lumber and other products. So the same type of thing could happen with some other areas where we're currently experiencing inflation now. It's also interesting to note that what the average person in the U.S. Notices the most is gas prices on average, but gas prices are still lower than they were a couple of years ago. So it has gone up, but that's not really a big shift relative to the overall 3, 5, 7 year price pattern. That said, given the somewhat elevated levels of inflation, the capital market expectations that just came out, I'll show you in a moment, we have an inflation projection increase by 0.25% on average over the last 10 years. But not a big overall shift, which is good news for people in general because it implies that the real returns of stocks and bonds over time necessarily think just find it from the isolated element of inflation in the long. So speaking of those capital market expectations, not a lot of changes for the 2022 10-year projections. Similar in major asset classes, identical in many major asset classes to 21 projections. Small increase in small cap returns, which will partially reflect the relatively out of favor status of small cap relative to the mega cap trend of the large cap stocks for some of the stay-at-home factors that I mentioned earlier. Inflation, as mentioned, up just a little bit, and a few other asset classes had some minor adjustments as well. Some of these changes you see in terms of the differences are within the broad bond markets that all sort of net out to the same overall bond market return, or no difference in the total bond market with some subsector adjustments within. In terms of the rules and regulations corner, you may have seen in our blog post or newsletter, newsletter, the new contribution limits came out. In some cases, savings level maximums, IRS max limits went up. This is good for those of you that are still generating income, or want to help you remind your kids have friends or relatives to up those savings to maximize the tax deferred benefits of savings. In terms of foundations and endowments, no significant updates there. In terms of 401k, again, the same IRS contribution limits are relevant. So for those of you that are 401k fiduciaries, we would encourage you to circulate some reminder, encourage people to increase their savings. Not everyone can save up their limit. Some can, some should be trying to save closer to the limit. Some can, but don't. The more you remind them, the more you'll be helping them with their retirement plans. In terms of retirement plans in general, a few topics to be aware of that you can look into or reach out to us to learn more. The Department of Labor has shifted with the current administration in Washington. The pendulum has swung back a little bit to a view that's less extreme against ESG or environment, social, and governance investments. There's a little bit more favorable there, which a welcome change for some that would like to express some views there. The IRS issued a frequently asked questions for the CARES Act. The Department of Labor also issued a supplemental statement on private equity in retirement plans. This is interesting, generating a lot of debate because initially they came out with this statement that sounded as if it were encouraging private equity, and they had to update that statement to mention that they weren't specifically encouraging it, but just acknowledging that it may be more allowable and acceptable than previously mentioned from the DOL view. It remains challenging for many organizations that are not many hundreds of millions of dollars large in terms of their retirement plans because of the access minimums, liquidity, and other factors, especially for daily valuation type 401k plans. So there are some challenges. Still make it challenging from a practical implementation standpoint. But if this news moves forward as we might expect, it could lead to more organizations trying to create higher liquidity private equity funds, which sounds a bit like an oxymoron because by definition, there's what's called a J curve in private equity, where you have to be ready for the capital calls, set the money aside, private equity firm holds the money, and then invest when they're ready, and it's not a publicly traded set of securities. So liquidity is a challenge. So to have a liquid fund in that nature may simply mean that they are maintaining a certain level of long-term cash within such a fund, which would imply a very different risk-return profile than what are sometimes considered to be relatively attractively high returns, but with a high risk profile. So could lead to being a bit different. In terms of our blog for the quarter, for the last couple months, you see some new titles, new topics we've covered here. One you might find interesting in particular to share with people you know who are not doing the same types of planning that you're doing. Some people who you talk to and encounter outside of our client base who are excited that the market's been so strong, but have upped their spending and plans without factoring in the potential market risk, and are essentially assuming a new high level, high water mark. And so it's for people you care about that you think have done well, that you want to make sure they are going to continue to be okay and live out their life goals. You might be doing them a big favor by encouraging them to do some planning to make sure that they aren't making overly aggressive assumptions about return expectations moving forward. A quarter or two ago, we mentioned that the average U.S. investor believes that the long-term stock market return will be about 20%, whereas most financial professionals believe that it's closer to 7%. So that can lead to some dramatic problems if people are building plans, setting up fixed cost structures and spending structures around returns that aren't going to happen that way. So again, you should all be in good shape if you are clients, and pass this on. Go to the website, take that link, send it to some people you know who might be doing a huge favor in the long run. Details on retirement contribution limits are also there, similar to what we talked about a moment ago. Some year-end tax savings. Of course, we're now past the year-end, so hopefully you and others saw that. For that, of course, advisors would have been also talking to you about that. If you're nervous about the relatively rich valuation of the market, there's a blog post on why a correction really shouldn't make you worry too much. And also some insights and learnings from Ironman training and racing to help you accomplish your big goals. So that's really the bulk of section 1. Thank you for attending. We hope you feel like you are getting the best support you can from the advisory group. I find some clients are not fully aware of all the ways we can help them. So if you have a question or something comes up, or if you're going to make a big financial decision, most clients that check with us and being very glad they did. There's usually some insight and value and nuance and support that either helps people save time and money or make better decisions. So be sure to check in with us and use us as your guide for a whole range of financial matters. If you have others you think we can help like you, we always appreciate you passing on an advisor's name and making an introduction by email. That's the best way for us to grow so that we can continue to spend our time focused primarily on clients rather than what some firms do, which is spend heavy time and resources on marketing and growth. For section 2, we'll go through quickly. This is what the overall business cycle looks like. See how it varies by section, and different types of industries tend to be better to do different segments of the business cycle. I referenced stock valuations a little while ago. You can see a relatively elevated compared to history. The U.S. overall market is towards the upper end. Small cap is more attractively priced, more towards the middle. The large cap growth with big tech stocks in particular, as well as some others, near the top of their historical range. International in the upper middle half, but still a little more relatively attractive to some, and so forth. The one comment that we would add to that is that despite those strong valuations, earnings are still coming in quite strong, and in a number of cases have been improving. So there's some case for the continued support of some of these valuations, although again, in the long run, it's more common after a period of this type of valuation to have some sort of pullback, and usually a 5-year subsequent period tends to be weaker after something like that. But that's all built into your plan and your strategy and the portfolios we build for life stage and spending needs. Volatility has remained at a little bit higher levels than the last 10 years or so, but really more around normal levels, although the volatility has ratcheted down closer to the unusually low volatility of the middle of the last decade. So that sometimes causes investors to be complacent and then overact when volatility increases again, which can then be a vicious circle to increase volatility if people panic. So don't be surprised if markets, when they do wobble, that might lead to more initial volatility, but don't let that overwork, because it's partly investor psychology factor. Some other numbers here in terms of corporate and national debt. No real specific comments. Just glance at these just for a second. I guess one comment is that household net worth with less spending, stimulus, checks and other things, the overall household net worth, including stock market, home prices, and it's really gone up strong. So if there's any overconfidence here, that can make the swing down consumer confidence, which is already starting to happen. More nervous investors and more volatility on the horizon. Overall, high quality stocks did better for both the quarter and the year. Portfolios, in particular, tax deferred portfolios, we have a lean towards higher quality investment managers or managers who rather use higher quality securities mixed into the portfolio, which can dampen volatility. It can lead to less hot return than a really hot speculative market. It tends to provide more downside protection on average by some margin. Things cool. That can be helpful for long-term compounding. Certainly is no magic recipe for avoiding volatility altogether. I'd like to do a quick reminder, and just to visualize here, the 5-step process we help all clients through over time: analyze, design, formalize, implement, and policy. This is also part of a similar process, both in terms of the investment process as well as the financial planning process, spending policy process, so forth. Can be a helpful reminder of both individual studies which we sometimes show about investor behavior. There are also a number of studies that show that fiduciaries are not immune to investor behavior problems. And that's one of the things we help with, being present to provide a steady hand over time to help make the best decisions possible with clients. So thank you for joining today. I appreciate your time, and I will end this portion of the webinar now, and questions come up. Thank you, and be well.